Welcome everyone to our webinar entitled Transfer Pricing, Is Your Company Paying Its Fair Share of Taxes? Presented by Butzel and the International Accounting and Advisory Firm of Clayton McKervey. My name is Stasevich. I chair the International Law Practice at Butzel. During our presentation today, as you may have questions, please feel free to send them in at any time throughout the webinar, and we'll be taking questions throughout the presentation and at the end of the presentation as well. Transfer pricing, why now? It's a very hot topic, and we're very pleased to present a number of items for our consideration. Why is transfer pricing a hot topic now? How do auditors review transfer pricing? What are some of the best practices for assessing transfer pricing issues? We'll also review various United States, global, and state developments in the area of transfer pricing. As the economy globalizes, as companies internationalize and set up abroad, international transactions across borders increase. The need for monitoring transfer pricing becomes ever more important as government authorities look for additional sources of revenue. Is your company paying its fair share of tax? It has become a major issue internationally, from the U.S. elections to protests over Starbucks and other corporations. For example, in the United Kingdom, Starbucks paid only £8 million in taxes in the UK. Since 1998, over $3 billion of sales. It went for over 5 years paying zero taxes by implementing such devices as charging back to various entities for use of its logo, etc. Because this has become such a high-profile issue, government authorities throughout the world and the United States have put this at the top of their list when undertaking corporate audits on a yearly basis. In addition to Starbucks, probably the second highest profile incident of transfer pricing coming to light is Apple. Apple's testifying, in fact, in front of Congress and explaining why it can make billions in profits and pay no taxes. While these are examples of large, famous global corporations, many companies, large and small, are facing increasing audit risk over transfer pricing because of the desire of governments to look for increased revenue and examine how companies are treating these issues in their books. Robert? Nemzin?
Thanks, Nick. Just a big picture overview. Nick mentioned a couple of the big companies out there that have been in the news with Starbucks and with Apple. This is something that's a hot button topic for companies that's being discussed in boardrooms, and it's on their agenda for corporate purposes. It's something that's regularly being disclosed in financial and SEC filings as a tax liability regarding any of its transfer pricing issues. And what's most important to point out here is the big name companies are in the news with like Apple and Starbucks, like we mentioned. But what's going on an increasing basis at the local level and at the smaller level, where we've got smaller companies, the small to mid-sized companies that are starting to get involved with these transfer pricing issues. It's a growing area for IRS auditors that are kind of feeling out the issues and using these smaller companies as the breeding ground for developing the case law and the issues for tackling larger issues. So this is an issue that's really affecting any multinational company regardless of size, even though the big companies are the ones that are getting in the news. What are we talking about for transfer pricing purposes? Big picture here. What we're really talking about is taxing authorities looking to get their fair share of income from multinational companies. And really what we're talking about here are two interrelated companies that something is being exchanged between the two of them. It could be selling products from a parent to a subsidiary. It could be collecting royalties. It could be providing management or employee services, providing loans to interrelated companies. What's going on here is the taxing authority is looking to make sure that whatever we're charging, especially if we're charging something in this situation, that we're getting a proper price for what's being charged, because the taxing authority wants to make sure that they get their revenue, and they're going to start looking to see whether or not we're reporting income, because they want to get more money. Again, it's going to be based on how much is taxes paid by country or state. There's always two taxing authorities that we're dealing with. For U.S. purposes, we could have a subsidiary in India, for example, where they might look at the same issues that we're looking at. But what we're looking at is properly attributing income to a country. So Alex is going to discuss a quick little example for how something like this works.
Thank you, Rob. Just to take a big picture view, I thought it'd be helpful to put some facts behind here. Let's take, since we're in Detroit, let's take a German company selling spark plugs to the U.S. You're making something in euros, you're selling it on a cross-border basis, and you're selling it to a U.S. subsidiary. Now, the German company is, in this case, manufacturing, doing all the R&D, and then the U.S. company is selling and marketing these products. Really, this happens, this is an issue for every multinational company. If the German company charges too high a price, the IRS is unhappy. If the German company charges too low a price, the German tax authority is unhappy. And while certainly Google and Apple are the big companies in the news, we find that most companies are really just trying to balance demands on both sides of the border. But let's talk about control.
So I'm going to quickly review a couple core legal concepts that related to transfer pricing. If you're not aware, transfer pricing rules for U.S. purposes is related to Section 482 of the Internal Revenue Code. And if you look at that section, it looks rather harmless. It's just a small one-paragraph section, and it's titled Allocation of Income and Deductions Among Taxpayers. But what's important to know about that is it's not that section in the code that we're dealing with. We're dealing with hundreds of pages in the regulations attached to this section. So there's quite a bit to get through, but the first core concept is control. And the control element is going to dictate whether or not we're subject to the transfer pricing rules. It can be easy just if we got a parent-subsidiary relationship, but what's important to point out is the code is looking at the reality of the control, not its form or mode of exercise.
And so in that situation, joint ventures also come into the purview of 482 regulations. So
exactly.
Just because you have a joint venture doesn't mean you're out of the woods.
Yeah, so you may be subject to the transfer pricing rules without knowing it, and that's where a control element comes into play. The second and most important element to analyzing a transfer pricing issue is arm's length. And what we're dealing with arm's length is that's the price for which we're charging for whatever transaction we're dealing with, whether it's the goods or services or any other exchange that I mentioned earlier. What the IRS is concerned with is looking at a facts and circumstances test for what two unrelated parties would charge each other in a situation like this. We want to ignore the fact that we've got interrelated companies, and what would an objective test look like for what these two companies would charge each other. Now, what's important to note about this is it's a facts and circumstances test, and the regulations don't give us guidance on what the best method is for proving whatever our arm's length price is. It's really up to the taxpayer to figure out what they need to charge for the purposes of the services, and we'll get into that a little bit later on for what kind of things that we can do to get you down the right way to charge.
And just as an aside, fortunately, transfer pricing rules on a global basis are consistent, and they're based on the Organization for Economic Cooperation and Development, or the OECD. If you haven't heard of that before, it's similar to the United Nations, but it's more focused on economic issues as opposed to the UN side of things. And just maybe from a practical perspective, yes, there are 5 methods, and it's certainly understandable that taxpayers globally get caught up in some of the nuances and the details. But what we've found over the years is that we think if you look at the where profits end up within an organization on a country-by-country basis, that can go a long way in figuring out where you have transfer pricing issues and how to mitigate those risks.
A key area for concern is international cross-border acquisitions. Both taxing authorities in any international acquisition can undertake an audit that would raise transfer pricing issues. It's perhaps the greatest overlooked potential liability issue when conducting due diligence. Quite often we have to emphasize to clients the need for spending some time on looking at transfer pricing issues that may be hidden in the target. And as we noted before, the larger companies, there's high-profile cases, but also medium, smaller companies. For example, any company that is just opening a subsidiary across the border and will have cross-border transactions with its new Canadian subsidiary is at risk for a transfer pricing audit. Other specific issues, and the good news is the issues are similar, the concepts are similar, in all 200 countries across the globe. However, many nations are just discovering this area. They're new to the field, they're new to taxing, and they're even more aggressive than you would find with Canadian or U.S. authorities. So there's good news in the similarity, but also bad news, and that it's spreading internationally and increasing with the level of aggressiveness of the authorities.
And what's important to note here is that these transfer pricing regulations can generate a lot of money for governments in a relatively short amount of effort. Because we're not arguing over meals and entertainment deductions or changes in depreciation. They're just arguing that you've been shifting profits offshore for the past 3 years. And that's a very different argument than what you might find in your regular IRS or overseas audit. Let me just put some numbers behind things that I think will illustrate some best practices with respect to how to get a handle on your transfer pricing issues. Let's take a company that's called Specialty Vehicle Components, where the U.S. manufacturer that conducts all the R&D is selling parts and providing management services to a UK distributor. And in this case, the U.S. company is generating $2 million in profits, and the UK company is earning $11 million in profits on UK sales. Well, the question I would have right off the bat is, if you did all of the R&D on a new product line, would you give up all of the profit or large portions of the profit to an overseas subsidiary or an independent company? Let's put some numbers around this. And I appreciate the slide's a bit busy, but at the end of the day, the IRS is going to have the same conclusion. The IRS is going to conclude in this situation, or quite normally, that the UK company should only earn a nominal profit here. So, well, assuming a $10 million transfer pricing adjustment, well, that would be additional 35% on that tax would be $3.5 million. And then, since transfer pricing is a big issue in the U.S. and elsewhere, they will assess penalties on top of that additional tax. So in this situation, it's 20% of non-deductible cash payment out the door on top of the additional tax you owe. Plus, you'll have interest because it takes a long time to resolve these issues. Plus, you have additional state taxes. And there's a double tax situation because just because the IRS has taken this position and made an adjustment, the UK is not going to give back your revenue, their tax paid that you've handed over in the UK. And so really, from a practical perspective, it's great to ask yourself, hey, would our company give up so much profit to an independent company distributing our product? Or alternatively, would we agree to sell someone else's product for this level of profit if, let's say, for example, we are incurring losses? And that kind of thought process or approach can really make life much easier over the long haul if you're taking a big picture view of things. Now, like I said before, while Apple, Google, and certainly companies that, pharmaceutical companies, are in the news, this happens, there's a couple things, thought processes that happen within companies that drive transfer pricing issues or transfer pricing audits and get companies in trouble. So where do companies struggle in transfer pricing? Well, let's say we've got this specialty vehicle company that operates as a borderless business. They're not focused on borders. They're just interested in making sure that we can manufacture something at a lowest cost as possible and selling in the UK at high a profit as possible. Well, in these situations, and quite often private equity comes under this issue, is that they don't think about transfer pricing. Well, the problem is that the governments do think. They're only focused on what's happening in their border. So what happens? Well, the transfer pricing policy or approach is decided at the last minute, cost plus 5, for example, or cost plus 10. That might be the right answer, but in a day, that may not be the right answer if you're coming at it from a fresh perspective. Perhaps a more difficult situation is where somebody's bonus depends on transfer pricing. So in this situation, if I'm the UK managing director, the transfer pricing affects my bonus, I'm going to make sure that the transfer price is as low as possible. I don't really care if it causes a problem for you on the US side. And one question we always ask in performing these projects is, hey, is somebody's bonus affected by transfer pricing? Because that could be the underlying problem facing for your multinational company.
So we've got a multinational company, and we've outlaid the risks that are involved. But how do we manage those transfer pricing risks? And the attorney in the room is telling you right now that you need to prepare some documents. So of course the attorney wants you to prepare documents, but that's, especially in the transfer pricing context, that's essential here for managing the risks. And what kind of documents are we talking about? What needs to be put in writing? It's really an overview of the companies that we're dealing with, and it's putting in writing, explaining how the business operates globally. It's profiling the business and the industry and what's affecting the business. And we're putting into writing, analyzing the transactions involved and the financials of the company that ultimately gets us to the arm's length price that we're going to settle on in our contracts. This is critical for laying the groundworks for documenting, for figuring out how we're going to defend that potentially later on.
A good question that just popped up here is how often do these transfer pricing documentation reports need to be prepared? Well, they do need to be prepared annually to be what they call contemporaneous or timely. But that being said, once the reports are prepared, it's a straightforward process to update on an annual basis. That's something we certainly recommend for our clients to make sure you're on top of the transfer pricing on an annual basis.
So how do you manage the risk? That's through documents. Why do we want to manage the risk? Documentation is the first line of audit defense with the IRS or for any other taxing authority that we're dealing with. It's something that we can point to in writing that you've done ahead of time that justifies whatever price that you're charging. It's hopefully going to reduce any penalty risks to the extent that there is an adjustment that is actually applied in the course of the audit. The documentation that we're doing is always requested for in every IRS audit. And not only that, some countries out there like Mexico and China, they require documentations to figure out how you got to your transfer pricing area. So it's something that's definitely on the IRS's radar. They have a new 2-year audit roadmap process for figuring out their transfer pricing cases. This is something that is a growing area of concern and attention for the IRS.
And just to interject there, the point of drafting these reports is so a tax agent can walk in the door, understand how your business operates, understand the transactions, and then has a good handle on what the company's position is with respect to the transfer pricing approach. Now, that being, I'm sorry, good question here. How long do these reports have to be? Part of that's going to depend on your company or how big the transactions are. It could be 50 pages, it could be hundreds, but the point behind it is that the key thing to remember is that if the report needs to provide a clean, clear explanation. And at the end of the day, what we tell people is that our clients or people who are in a due diligence situation, if a report doesn't make sense to you, it's not going to convince a tax auditor. So why? I may not know anything about your company, but I really should have a good handle on how that business operates after I review it from a 30,000-foot level. We always suggest having product pictures and website materials. It really does tell the story for you. And we also emphasize plain language in these reports for two reasons. One, it makes life a lot easier in terms of explaining your business. And two, remember, it's not just going to be the IRS agent reviewing this report. It might be someone overseas where English isn't their first language. So again, these are just rules of thumbs that over the years has made a difference between a company that's been in an audit or is selected for further action versus someone who has a report reviewed and the auditor moves on to the next company. If you have that, you've won.
Like Alex was saying, the more straightforward this documentation is, the better. We just need to have a random person come in and look at this and see if they can understand it. I'll kind of liken it to like a business plan for a new company starting out, that maybe they're looking for investors or they're looking for a pitch. They're going to try to cover as many bases as possible and make it simple as possible for people to understand. That's what we're talking about here for transfer pricing purposes and for tax-related purposes. So is the IRS or any other taxing authority going to understand what you got in your report and how you reached your result for whatever you're going to charge?
And one last question on that point and this is an important point, is that you want the same report. Ideally, you want one report justifying transfer pricing to both tax authorities. And again, you don't want to tell one story to the IRS and one side to the Canadian Revenue Authority. That's going to create heartburn over time. All right, so let's provide some. I thought it'd be helpful just to provide some best practices that can help you on a day-to-day basis figure out if you've got a transfer pricing issue or not. I've found over the years that probably 70–75% of the reports that I write involve a benchmarking analysis of your subsidiaries. So just to be clear, this would be taking a look at the profits generated by the subsidiary companies and comparing them to what are called comparable benchmark companies in the same market. Now, to be clear, these are not going to be companies that are your direct competitors. In fact, they may be companies you've never heard of before. But for example, if you're distributing apparel in the U.S., you would be comparing, if you've got a subsidiary that distributes apparel in the U.S., you may have them be compared to independent apparel distributors in the U.S. but that may not be direct competitors for the company as on a global basis. But what we suggest is to look at the profits of your subsidiary on an operating margin basis or earnings before interest and tax as a percentage of sales. Why? It's easier, it's a fairly straightforward number to calculate, and two, that's quite often what is used as the benchmark profit indicator in these transfer pricing studies. So starting with the profitability of subsidiaries, well, if I've got losses, if I'm incurring losses, or I've got small profits, well, the subsidiary side tax authority is going to have a problem. If I have large subsidiary profits, it's going to be a parent side issue. Now, why do we focus on the subsidiaries? Well, it's a lot easier to determine what the correct or arm's length level of profit is on the subsidiary side versus on the parent side. Now, your company may be much more complicated than this, but remember, if I'm a tax agent, I may not know anything about your company, but I do know how much tax you've paid, and that really should be the driving factor for assessing risk. Now, let's put an audit example that we came across just recently, where we had a UK parent, which was in a US subsidiary, and frankly, I was quite surprised that a company with 20 million in revenue was audited for transfer pricing, but that seems to be a growing trend that the middle market clients are being hit. But the IRS challenged $3 million in management fees because they felt the salary and other management services charged were excessive. From my perspective, I felt that they were cherry picking in terms of the transaction they're focused on. We came back to them and said, well, look, IRS, at the end of the day, this U.S. company is earning very large profits. So at the end of the day, the IRS, you should be writing a thank you note because we're overpaying our taxes at the end of the day. So the IRS walked away just based on that approach, and under the 42 regulations, that's permitted. That being said, we came back to the parent company and said, guess what? You may have a UK transfer pricing issue because your US subsidiary is earning too much profit. So those are the thought processes that are important for getting a handle on this transfer pricing issue. Let's go to a US side parent. Appreciate the slide's a little busy, but for a US company that has operations in China, India, and the UK, it's important to look at the subsidiary profits for each of the subsidiaries. In this case, if I'm a Chinese subsidiary that's earning 30% EBIT margins on sales to the US, well, I'm sure the Chinese tax authority is happy with that, but the IRS may ask questions about why are you putting so much profit there? There may be a very good reason for it, but it needs to have an explanation. For India, a lot of companies have business process outsourcing operations in India. Time after time after time, we find that the India tax authority has very aggressive standards for what they expect as margins, cost plus 15, cost plus 20. So I would expect an Indian transfer pricing auditor to issue an adjustment right off the bat. And on the UK side, well, if we're selling from, again, the US to the UK and we're incurring losses in the UK, well, the UK HMRC tax auditor is probably going to have a problem with that. That being said, there may be very good reasons for, in this case, the UK company to be incurring losses. Let's say we're starting up a new product line there. Let's say we've had a major drop in sales. At the end of the day, you have a much more convincing argument as to why those profits or losses are reasonable if you're putting that story up front as opposed to waiting until the IRS or the HMRC or other tax authority is knocking on the door and requesting your documentation. All right, so just jumping ahead. So if to summarize some best practices, operating losses are always red flags, especially in the subsidiaries. Large profits in subsidiaries are red flags. And more recently, I came across a situation where a startup had large profits in the first year and big losses in the second year, just based on business fluctuations, market conditions. They were still picked up for an audit, but Fortunately, we had worked with the company on providing a reasonable explanation, so we're not panicking or trying to pull something together at the last minute. Good question here. What is that operating profit or EBIT margin that you should focus on? I hate to say this, but it's going to depend on industry to some extent. Tax authorities expect companies, pharmaceutical companies, to have high margins or high subsidiary margins. The automotive industry, maybe not so much. So unfortunately, having a hard and fast rule here for what's a correct or proper level of profits is unfortunately easier said than done. All right. So I would ask yourself, when you're taking a look at the narrative or the profit levels that you're looking at, does it fit into a narrative that we're a subsidiary and we should earn steady profits over time? Because that's the IRS or other tax authorities' starting point for subsidiaries. There's another good question. The question is coming across that, how many years back do you have to look? Well, we find that a best practice is to look at all open tax years and also on an individual basis, just to make sure you're covering all your bases. And the last bullet point I just wanted to put out there as an aside, we find that companies that have net operating losses in multiple jurisdictions or one jurisdiction actually maybe can improve their cash flow by utilizing losses. So for example, if I have $1 million tax NOL in France, for example, and I'm paying tax everywhere else, by correcting our transfer pricing and making sure that the French, let's say in this case a subsidiary, is generating more profit, we're correctly reducing the amount of tax, let's say we're paying in the US, and utilizing the tax loss in France in this case. At the end of the day, this exercise, this transfer pricing assessment exercise, can actually generate cash savings for companies, and quite often we find that's a pleasant, pleasant development just from taking a fresh look at things. So, I
the
think
broader picture of best practices point, maybe for the leader of finance department to communicate these issues not only to the relevant professionals and her or his staff, but also up to management, up to the board in these developments. And secondly, to invest some resources, not only in educating your staff in the U.S., but the counterparts abroad. I've had the opportunity to watch an expert like Alex, who's leading his transfer pricing practice at Clayton McKervey, give an educational seminar to an in-house group, and something like that can be very impactful and can save millions down the road.
Absolutely, and Nick, when doing these projects, actually the first thing we came up with is there a way to utilize losses, and because it's an important part of managing your transfer price and risk. So it's really a pardon the cliche, win-win situation, and and why not resolve a tax risk while we're taking a fresh look at our company as well? I think Robert's going to jump into some interesting cases that we think are directly relevant to transfer pricing for companies of all sizes.
Yeah, so one final area we wanted to touch upon was the recent developments in the legal area that are trying to enforce these rules. Like I mentioned before, that there's increased focus on these items by the IRS, and one of the most well-known cases that are out there right now is Coca-Cola. We prepared these slides a while ago. If you subscribe to the BNA tax service, you may have noticed this morning there was a story exactly on this case. So if you're not familiar with it, it's a case that's currently pending with the U.S. tax court, and Coca-Cola is challenging a $9.4 billion transfer pricing adjustment that the IRS made on some licenses that Coca-Cola did for its intangibles that it made to its abroad companies. What's interesting about this case and what the story in the BNA this morning is that Coca-Cola had this approach that they previously had with the IRS that the IRS was okay with. But the IRS has now changed gears, and they're now challenging tax years 2007 through 2009 and recent years, and the IRS is really walking away from the longstanding agreements that they've had with Coca-Cola on this issue. And so this has created quite a buzz among the transfer pricing tax community, because the IRS is just completely changing gears and basically doing whatever they want to do for figuring out how they want to tackle transfer pricing issues and arm's length transactions.
And what's interesting, so effectively, what does that mean for many other companies? Well, I know many companies haven't been under audit before, or they asked about the transfer pricing, received the report, walked away, and you may suspect they never read it before.
Right.
That we think times are changing there, especially since we're seeing them, the agents both in the U.S. and around the world, taking a look at companies that certainly weren't on the audit screen not too long ago. And I think Robert and I were kind of sitting there thinking, well, it's interesting, this is a fast track case covering issues from back in 2007.
Right.
So,
and just to show you how truly international these issues are, Coca-Cola is also under audit right now from its operations in Vietnam by Vietnamese auditing authorities. They haven't paid, from 1994 through 2014, Coca-Cola didn't pay any tax for its operations in Vietnam. So this just shows you that there are multiple jurisdictions where transfer prices is going to be an issue. Coca-Cola has problems right now with the U.S. and with Vietnam as well.
and that may be due, the Vietnam issue is in particular, that may be due to somebody's bonus depends on the prices charged into Vietnam. Who knows, it might come up in a court case someday in Vietnam, of all places, but at the end of the day, it's something that is a publicity problem for Coca-Cola, and once these court cases come up in Vietnam, they also seem to spread like wildfire.
One other case that's of note that's pretty interesting is the Henry Schein v. Commissioner case. Henry Schein is a healthcare product distributor, and they are currently under investigation with the IRS. They were hit with a $119 million adjustment for the IRS claimed that they weren't charging enough for the services they were providing to their subsidiaries. This is a pretty important case because this could create some precedent for future service provider issues where parents providing services, and the issue is, first of all, are we charging services to the subsidiaries for the services, and if we are providing the services, are we charging enough? So this is a good case to keep an eye on, just to see where the IRS may go with these issues.
And Robert, would you mind just commenting on how intercompany contracts might fit into this type of situation?
Well, the intercompany contracts, like I said before, with the documentation piece, to put in writing how you reached your result for whatever you're charging. If we've got contracts between the parent and the subsidiary, and we've got something that we can point to in the documents for how we reached our result for what we're charging, that's going to go a long way in this audit with the IRS.
Even if you, and we strongly suggest, even if you're a new subsidiary coming in for the first time, or you're setting up a subsidiary at the first time, we strongly suggest that you have an intercompany contract, just to make sure that roles, responsibilities, and intellectual property ownership is handled, or at least thought through, long before an auditor comes knocking on the door.
And I'm glad you brought up intellectual property, because that's one of the most overlooked issues in this area.
Again, let's switch out to maybe take a broader look and look at the global issues. And I think a lot of companies, certainly the very largest companies have thought about this or heard about this, but the OECD, in response to all of the transfer pricing outrage on big companies not paying their fair share of tax, has come up with a base erosion and profit shifting program. long story short, this is just a new era in transparency. Now, but effectively for companies over 750 million euros in revenue are actually going to be required to report how much sales, income, and income tax are generated on a country-by-country basis. What's different here? Actually, every tax authority can have access to it. So an Indian tax agent will know how much income tax you're paying in the US, UK, France, South Africa, Australia. Doesn't matter where in the world that you have operations. At the end of the day, this is very new. It's starting for the 2016 year. But at the end of the day, it says to tax auditors, you can see how much of the tax pie your country is receiving versus other locations. So that's, I think, going to be a monumental driver of some tax controversy over the next 10 years, frankly. What I think, though, is from what's often underlooked here is that actually there's, as part of this BEPS program, is that there are more prescriptive requirements for transfer pricing documentation. Granted, the big picture items of what we covered before are still in play, but there's certainly new higher expectations on what a tax auditor is expecting to see as part of documentation. And they're both also looking for what's called a master file, which focuses more on the company as a whole, and local files which focus on individual country transfer pricing requirements. And the next one. Here's another surprise.
For U.S. purposes, we've really only been focusing this discussion on the IRS, but we don't want to lose sight of the fact that we have state law, state audits of companies as well. And there's an entity out there called the Multi-State Tax Commission, if you're not familiar with them. And it's a pooling of resources among states to, it's a group that's designed to lead sharing of resources among states for their taxing authorities. And recently they've just, there's a commission that's out there it's called the Arm's Length Adjustment Service. And as of now, 6 states have joined. It's likely going to grow. What this does is it's going to pool the resources to develop a multi-state transfer pricing services resource for each of the states involved to check in and see what's going on, and pooling resources for use in litigation and using experts and outside consultants for coordinating transfer pricing issues at the state level.
And really, congratulations. I'm sorry. The states have not necessarily been as sophisticated in transfer pricing before, but now, surprise, they've got outside consultants to help out. Unfortunately, some of them actually are remunerated on a contingency basis, which I found particularly troubling. Although New York is the one state that's always been quite good at transfer pricing audits, and we expect that to continue in the near future.
This is perhaps my favorite slide in a presentation. These are actual quotes for cases that Alex Martin has seen in his decades of experience in this area, and as well from Robert Nemzin in his corporate individual tax practices. Taking Friday from the most innocent at the top, our parent company said they prepared a study. These are actual quotes that were said by companies caught flat-footed when confronted by the auditors. To perhaps the most difficult explanation that the losses are due to poor market conditions, etc. You can see some of the other examples there, and just more motivation to be proactive in this area.
And realistically, even the newest auditors have heard the last one, and it's usually the easiest one for them to generate an adjustment. Would you, as a subsidiary, if you were buying from someone independently, would you continue to buy from them year after year after year if you were incurring losses? And sorry, good question here. How do tax authorities look at foreign exchange issues? they normally think that the parent company should bear foreign exchange risk, and that's both from the IRS and other tax jurisdictions as well. All right, well, just some transfer pricing takeaways here. I hope this has been very productive, or bring some insight on how auditors approach transfer pricing, and provide some tools for how you can proactively address, not just from a tax risk perspective, but perhaps from a cash management point of view. Look, it doesn't matter if you're if you're Coca-Cola or Google or a pharmaceutical company, or if you're a Canadian company setting up shop in the U.S. for the first time, or from China, or for what have you. All multinational companies have transfer pricing issues. It goes without saying. And because those prices affect how much tax you pay here versus another country. We think a best practice is to start by reviewing subsidiary profits. EBIT as a percentage of sales is probably the most straightforward way to calculate things. And if you're trying to figure out from a 30,000 foot view or 10,000 meter view, why do we earn this level of profits in this country or state? Well, that's a lot better place to be than if you're asking that question 3 years from now. And no matter what you take away from this, documentation, intercompany contracts, and transfer pricing policies are certainly great things to think about now, as opposed to when the audit comes and they ask you for everything you have with 30 days notice. So whether you're a subsidiary working with trying to get a handle on U.S. rules, or you're a U.S. company trying to handle transfer pricing on a global basis, the general principles and tools that we've been talking about here are all applicable on not just for the U.S. but on a global basis. So hopefully we've left our contact details on the next screen, and certainly we want to answer any outstanding questions or other questions if in the meantime. Is there a way we can get a copy of slides? Short answer is absolutely. We're going to be posting these online, and also sending them to all the participants. So we'd be honored if you downloaded a copy and keep it for your files, or share with friends for that matter. All right. All right. Well, look, we had a couple good questions that came up over the presentation, and I appreciate your attendance and participation. We trust that you found this a helpful explanation of this growing area. And again, please feel free to reach out to us if it may be of interest. And again, thank you for attending.